Fine with me.
I'm ready.
Okay, so I will let everybody in. Hello, everyone.
Hello.
Hello.
Hi, Dale.
Please get yourself a drink and settle down.
Hello.
Hi.
Oh, Michael.
Folks.
Nice, and Adrian.
Hey, what's going on?
And Blake. How are you?
Hey.
Dale.
You guys want to see something?
Michael Wilcox. Hello.
Hey there, Jared.
Good to see you.
Rudy.
Anish.
Anish. All right, the gang's
Hey,
all
Paul.
here. It's like
Hey,
a
Hugh,
long
check it
weekend.
out.
Oh my goodness.
Oh, congratulations, Adrian.
Oh.
Hi. Hi. Oh, you don't like that? You don't
So
like this?
I guess you're the father.
I am. That's why it lives with me and my wife. Yeah. Week and a half old.
Wow,
Yeah.
brand new.
Yeah.
Congratulations.
Thank you.
Oh, Gary and Jim Dunley.
Oh.
Hugh, I like this better. You can say hi to, talk to everybody, not just get stuck near the bar and talk to like 2 or 3 people.
Yeah, that's right.
Hey Sri, hey Hugh.
Hello.
Hey, Martin. Oh, Carlos.
Oh.
How are you?
Good.
Good to see you.
Evening, everyone.
I think people are still coming in. I'm just admitting as people are coming in.
Adam.
Hello.
So there's this option of rooms in Zoom. So maybe we could even have like cohorts, like, all the equity guys to go to one room, all the fixed income guys go to another room. So we can even like, split the room into multiple rooms.
Or we could listen to Jared's talk.
Hi. So do we give a couple more minutes? It's 7:02.
Not many more minutes because people get bored.
Okay. So Hugh, do you want to make announcements?
All right, okay. At the CFA Boston, we have on July 23rd, what are the critical characteristics of executive presence that leaders need to demonstrate through the next phase of the COVID crisis? Another one is a webinar, generational investors and their pandemic response. And then there's intro to Python for finance. And if you want more details, you can go to CFA Boston. And we have an update on the Tennis and Racket Club. They're currently only allowing 25 members into the whole club. So, any other announcements? Speak up. There's no such thing as bad publicity. Any takers?
Hugh, I had one. Tomorrow at noon, we have our Quant University Summer School Lunch and Learn series. Joseph Simonian is going to be talking about model validation for machine learning models. It's a 1 hour thing and it's free. I think you already sent out like a notification. Everybody's welcome.
Yeah, isn't he the, one of the editors of the, one of the data science journals?
Yeah, so there's this new journal of Financial Data Science, I believe. So he's one of the editors.
Okay,
He's ex-Netaxis, and Francesco Fabosi is one of the editors.
okay.
Yeah.
All right, well, let me introduce Jared. Jared Wilcox is president of WealthMate. After a career in teaching, management consulting, institutional investing, and high net worth investment advice, he is now developing software to make financial decision-making more productive. His books include Investing by the Numbers, and as a co-author, Financial Advice and Investment Decisions, a Manifesto for Change. Jared is also known for Gambler's Ruin Bankruptcy Prediction, the PB ROE stock valuation model, and the discretionary wealth approach for linking financial planning to investing. And with that, I will hand it off to Jared. Thank you.
So Jared, you're the host now.
Okay. Thank you for coming. It's going to take a second for me to figure out exactly how to share my screen. Okay, you should be seeing a title page.
Yes.
And tonight, my topic is better portfolios with higher moments. I assume everybody here has had some exposure to Markowitz mean variance optimization, and you know its strengths and weaknesses. And I'm going to address some of the weaknesses without stepping on the things that are good. I'll stop several times for questions or comments. So this is an experiment. It's different from a webinar because you get to talk. And I'll probably stop for 5 minutes or so several times. Okay, let's see what I do to do the next one. Let's begin with a blank sheet of paper and establish a tool set for higher moments. And it's going to have 3 big tools. The first is, let's abandon all these intermediate statistics like mean and variance and represent joint return probability distributions with a scenario matrix. The matrix I'll describe in a minute, but basically you have to forget everything you've learned for just a few moments. The second tool is to match that representation of probability with something that can optimize. And we're going to use an open source package that works on convex optimization problems. And the particular package I'm using now is a Python package, and it's called CVXPY. In the paper I wrote for the Journal of Asset Management, I used a different hill climbing one. This one, the new one, is a little bit more robust. The third thing, which I've been talking about for almost 20 years now, is a tool for direct expected utility maximization, including higher moments, expected natural log of 1 plus LR, where L is risk aversion parameter. I think of it as leverage. I'll explain that in a second. And R is a random outcome of returns. And we're talking about for the portfolio. So that would be the portfolio return. And L is the same risk aversion coefficient used for mean variance, where you have expected R minus L times the variance divided by 2. Okay. That's a practical implementation of Mark Rubinstein's generalized log utility, and I can go into that a little more later. But right now, I'd like to look at a very simple problem structure. So the left-hand box is labeled return matrix, and each row in that is an observation of returns from different securities or a scenario of returns for different securities. And that can be just limited to actual historical returns, or you can modify the returns, you can shrink them. A very simple shrinkage would be just to make all the securities in the same asset group have the same mean, let's say. Or you can add rows. You can take that return matrix from observations and construct a model of whatever you like, probability distribution, and add a bunch of rows to draw from that probability distribution. So it's very flexible. This is the most flexible statistic I can imagine, a return matrix. And up above, you see allocation A. That's a vector of allocation percentages or fractions. And we matrix multiply that candidate set of allocations by the return matrix, and we get portfolio returns that reflect the return matrix and the allocation. Then we multiply all those times a leverage, which in this case, in common with Markowitz, we know the person's risk aversion. That's kind of a stretch, but we could, if we wished, represent leverages with a vector as well and represent probabilistic risk aversion. Finally, we convert those leverage portfolio returns into a log representation by taking the natural log of 1 plus those leverage portfolio returns. We add them all up, and down at the bottom, you can divide by the number of rows and you get the expected log leverage return. So maximizing expected utility is actually much simpler in concept than what we usually think of as mean variance optimization. Let's come back to the matrix of returns and talk about its flexibility. So they don't have to be returns of securities. They could be returns of factors, for example. And generally, if you're doing something commercial, you might well choose to represent things in terms of factors. You can modify the returns directly to reflect a longer history. Very often, you might have 20 or 30 years of returns, and you say, well, gee, I'd like to reflect the fact that I really know the risk premium for equities is like 6%, and just put in some priors. You can shrink. You can accommodate active bets. Like think of someone trying to put in their alpha as a modification of the expected returns for a particular security, or taxes. After-tax returns can be easily represented. You can, even if you put in enough rows, think in terms of path-dependent taxes. Or you can add scenario rows to reflect two things. One is just a smoother probability surface. You could think of bootstrapping. I kind of suspect that this is what's going on with Dick Michaud's efforts, that he's not directly modifying the return matrix, but by essentially trying out different allocations, he takes advantage of smoothing a probability surface. Or the gold standard, in my view, is probably constructing a Bayesian prediction distribution and drawing from that to get more rows. And I've run these with 1 million rows, and if you pay some attention to performance, that's quite practical. It's not just flexible and simple, but it has a more comprehensive utility function. So around 1976, Mark Rubinstein published something. By the way, I invented all this, but I invented it 20 years later than he had. So it didn't quite amount to the same thing. But Rubinstein's expected utility encompasses both mean variance and higher moments. And over at the left there, you see expected natural log of 1 plus LR. That's a different implementation, but the same idea as Rubinstein's natural log of wealth plus some arbitrary constant. In my case, the arbitrary constant is negative, and it's a representation of your required funding from the investment portfolio to support your future needs. So we're going to express that as a Taylor series, and I've done that on the right. And I noticed when I expressed it as a Taylor series and then took the expected value of each term, that there was a common expression that kept appearing, and I've labeled that as Q up above. So Q is the risk aversion parameter, which I call leverage, times the standard deviation of return, divided by 1 plus the risk aversion times the expected return. And the value of Q turns out to be very important for deciding whether or not this Taylor series converges. So if it's like 2, you know that it's going to blow up and people are going to go broke immediately. If it's substantially less than 1, it will rapidly converge. And let's look at each term. So there's something that's got variance in it, Q squared divided by 2. And then there's something that reflects S, which is skewness, and Q's raised to the 3rd power. And then something that represents the 4th power of Q times the kurtosis divided by 4. If you stare at that long enough, you'll know a lot about the market. If it turns out that people with Rubinstein utility are well represented in the market, i.e., because they've followed this wonderful utility, they've gotten rich. Mm-hmm. In an efficient market, one thing you need to remember is that in an efficient market, both the expected return and the variance are roughly proportional to the elapsed time between each observation. And as the time shrinks toward the continuous case, that sort of complicated looking Taylor series converges to LE minus L squared V over 2. And if you assume that we really know the risk aversion, that will give you the same optimal allocation as Markowitz. It'll just be E minus LV over 2. Another way you can get to that convergence is for L to shrink. If risk aversion becomes smaller and smaller, you get closer and closer to Markowitz. So you get a rough idea of when Markowitz mean variance is going to work, i.e. when Q is not very big, and when it's probably not going to work very well when Q is big. And that will happen when you get a big product between risk aversion and the standard deviation of return. So I'm going to stop there. Any questions or comments? I will go on if you don't have any. Are you still there? Well, what do I do with this? What we're going to do is study where higher moments make more difference. And I'm going to look at a sample of 5 mutual funds that happen to have long histories that are all sort of like index funds, They're all Vanguard funds. And one is a big stock fund, a small stock fund, a cash substitute, a junk bond fund, and a pretty good corporate bond fund. So I have 40 years of monthly returns. And I can, if I wish, look at monthly returns, or I can look at returns every 2 months or every 4 months, because I'm starting with prices. And these prices are adjusted for dividends or income. So that will all be fine for getting an optimal allocation, although your confidence intervals will go down if you use, will spread if you use overlapping intervals. Okay, so I've taken a case where you have presumably very small influence of higher moments. And studies of this, the need to use higher moments, have mostly said, well, there's not much need. But of course, they tend to study cases where there isn't much need. And here I've constructed a chart of the 2 funds added together that are in stocks, that their allocation to the optimal portfolio measure derived 2 ways, one by mean variance and one by log leverage surplus, which is the method proposed here. And the leverage can either be 2, which would be sort of a mildly aggressive institutional risk aversion, or 1, which would be similar to the Kelly rule, which is just growth optimal without considering surplus, all the way up to fairly conservative investors. So an investor with a risk aversion of 8 would be really unwilling to lose more than 12% in a given month. And if you optimize, and I'm using 2-month intervals here to make it stand out a little more, you get no difference with low risk aversion, and then it gradually increases as you have more risk aversion, but it's really a fairly small effect. And I'm not surprised that people generally don't find much. On the other hand, if you look specifically at a fund like the junk bond fund, that, if you remember, had super high 4th moment through high kurtosis and a fairly negative skewness. Go ahead. No. Mean variance optimization at the left-hand side for monthly returns would give you, in this case, a allocation of around 18%. The proposed method, taking into account higher moments, would put about 1%. And if you looked at 2-month intervals, none. So what we're getting there is a protection against tail risk. And that protection is not only for end sample, but it says, you know, if you've got such high kurtosis, if the variance goes up and the kurtosis gets multiplied by variance squared, it's going to be a really big number. So you're protecting against out of sample increases in variance by avoiding junk bonds. This is kind of common sense, you know. This is what normal high integrity financial advisors would tell their clients. If you're retired and don't have a lot of money, you know, maybe you shouldn't invest in junk bonds. But mean variance would tell you, go ahead. Now I'm combining a fairly conservative investor with leverage or risk aversion of 8 with different time intervals between rebalancing. So 1 represents every month, and 16, we go more than a year before we rebalance. And if you're looking at real investors who are not having their money managed in some professional way, they really don't change all that often unless they're kind of hobbyists who think they can beat the market. And the tan bars represents the mean variance optimization. The blue bars represent the log leverage surplus optimization. And you can see that mean variance just happily goes along at around 25%, no matter how long you take. But if you pay attention to higher moments and look at longer time intervals, it's really quite important to avoid higher moments that are unfavorable, like kurtosis and like skewness. And if you recall, I don't know that it's easy to go back here, but if you recall the setup initially on this sample, the stock-related funds had negative skew and the bond-related funds, except for the junk bonds, had positive skew. So the negative skewness on stocks, and everybody, by the way, had kurtosis that was sort of 4, something like that. And keep in mind that even a normal distribution has a kurtosis of 3. So even if you think distributions are going to be normal, which they typically are not, you still should pay attention to the 4th moment when you have long time intervals and are conservative. So what does this tell you about proper matching of product to investor? Maybe there's room for people who specialize in servicing slow, conservative investors. If you think that these investors represent that, if you think that investors with something like Rubinstein's utility represent a significant portion of the market, what would pricing look like for illiquid investments like, venture capital? You know, you got a 10-year payout period before you can get out. You know, probably you'd get higher returns because you'd have to compensate for this high kurtosis effect. Okay, I'm going to stop again if there's anyone who wants to comment. Just because the other person next to you, you know, might be critical of your comment, don't be shy.
Jared, this is Anish.
Okay.
Yeah, I just have a question. Do you just use this for asset allocation, or would you actually consider using this to allocate to securities?
I would consider it for securities, but the more you get into securities, the more you have to deal with the fact that you've got small sample representation. I used here, you know, aggregate securities, and I had 40 years, 480 observations. So there wasn't a huge small sample problem, but if you had 20 years and you had individual securities, you're going to have to do some modification of the return matrix. You're going to have to pay attention to things like shrinkage. God forbid you might use risk parity, but I object to that, but you might. So the answer is yes, you can use it for securities, but in this study, I've left out entirely the business of modifying the risk matrix to get a better prediction of the outsample. In the code that both Shri and I are providing, you have the opportunity to use one simple modification, which is just basically making the means all equal to some long-term average, getting rid of that source of small sample error. But the idea is that if you get involved in this, you would construct your own little subroutine that would modify the return matrix to make the best prediction. So what I'm doing is I'm not trying to make a good prediction, or I would have shown you the out of sample performance, but I'm trying to show you the way the different approaches to optimization are structured. Anybody else on this second section? Okay, I'll go on to the third section. In this approach, there's nothing to keep you from including options. They're first-class citizens in this structure. So you can optimize portfolios with options and other securities just as well. And in fact, that sounds like a good idea because we're taking account of their higher moments. I would have had to go to quite a bit more document to try to build a empirical test of what it would look like with actual option prices. But I could still do some interesting things with options if I used hypothetical Black-Scholes option returns. So I'm going to do that. And we're going to contrast the Black-Scholes, and I should say Black-Scholes-Merton option model in an investor portfolio context. So real investor portfolios, well, investors have different risk aversions. That's nowhere to be found in the Black-Scholes model. And it might have some influence. Arbitrage is not going to happen instantly. You can't continuously arbitrage. There's going to be time delays. You're going to have holding constraints. A lot of people are going to be confined to long-only portfolios. Many people will have taxes. I'm not going to do taxes, but I'm going to do the first three. And it's not surprising that given the kind of idealized context with an isolated continuous arbitrage model, this is continuous time finance gone crazy, with an isolated arbitrage that doesn't take any account of the rest of the portfolio and no account of any time delays, that the model would produce so-called implied volatility anomalies. So the implied variance is typically much higher than the actual variance. The out of the money prices for options give you a higher implied variance. It's not symmetrical. There's a smirk rather than a smile. You know, the protection against downside is a lot more valuable than the protection against upside. There's one more anomaly, which is that longer duration options are priced higher. I didn't happen to study that in the paper for the Journal of Asset Management, but I did in what follows. No, that's not true. Is it true? No. So here's the setup. It's 1 month Black-Scholes hypothetical options on the S&P 500 index fund that Vanguard was using called VFINX. And it's European puts or calls without dividends based on stock prices that were already adjusted for dividends. It's the same 480-month sample, but we have a spectrum of both investor risk aversions and strike prices as a percentage of spots. And I did not investigate longer maturity options. So what I did was using the sample average volatility and the interest rate on the cash substitute, I constructed a hypothetical option price at the beginning of the month. And then at the end of the month, I looked to see what it was worth with the payout. And from that, it just added a new column to the risk matrix, to the return matrix. And so then we're in the same process again. We're running through optimizing a return matrix. And this is a heat map showing the percentage of the portfolio that was put into puts. And the rows span different leverages, with the top row being the least risk averse and the bottom row being the most risk averse. And then the P100 is an at the money put. P101 is in the money. And then as you go down to P93, that's a 7% out of the money put. And these are the optimized percentages you would put into the put. So the first thing that I observe, and I don't know if my pointer is appearing here, but if it is, you see that once you get a little bit out of the money, 4% out of the money, everyone, not looking at taxes, but everyone, no matter what their risk aversion, wants the protection of an out of the money put if they were priced according to the Black-Scholes model. So that explains one of the anomalies, which is the implied volatilities are always higher than what you see as actual risk in terms of variance. And you'll notice that if you add up the different rows, you get more and more demand. And of course, we don't know how to weight these different rows because we don't know how many investor dollars are invested at each risk aversion. But it's pretty clear that the sum of these rows goes up as you move to the left. And that explains at least the left side of the smile. Okay. And there's essentially no demand for in the money puts. Okay. Now let's do the same thing for calls. And I was kind of surprised about this because, you know, in the real world where we have taxes and other constraints, I don't think you see this, but calls, you know, also produce a more positive skew, but they act as a substitute for stocks as opposed to a hedge against stocks. And so if you're not very risk averse, you want quite a few out in the money calls. What do I see? Well, there's almost no demand for out of the money calls. So if calls were priced according to the Black-Scholes model, the only demand you would see for the right side really would be through put call parity, which is another arbitrage, but you know, that's a secondary effect. So you would expect the left-hand side to be higher than the right-hand side. So we could have gotten to this conclusion a lot quicker if we had just looked at the Taylor series. If we believed that kurtosis and the fourth moment were priced, how would we create a smaller kurtosis? Well, we'd sell out of the money calls and buy out of the money puts. And since that was valuable, the puts would have to be pricier than the calls. So that's another way of getting to the same answer. So these two charts, my interpretation of them is based on an assumption, which might not be true, that a significant portion of market pricing is driven by something like Rubinstein's utility model. Okay. Any comments on that? I've now attacked at least 2, but maybe 4 different Nobel Prize winners. And I'm never invited to speak at universities. Summary. Expected utility, I'm just going to read this because I couldn't say it any differently. Expected utility optimization, including higher moments with probability expressed in scenarios, is surprisingly practical. And you can see that in the code. It's just, you know, a normal looking Jupyter notebook, and you can make it run faster by taking the code out of the notebook and getting rid of all the print statements. And you can make it run a lot faster by recoding it as C, but it's all very simple. It's sort of guaranteed to be a convex problem. And I know that because I'm using CVXPY, which is advertised as throwing up if it runs into a non-convex problem. It's surprisingly practical. You can try it out. If you look at, quick memorize this, if you look at GitHub, Jared Wilcox, all one word, /wealthmate_lab, you can download the code of my best current version. The version that's in the Journal of Asset Management will also work, but it has some hiccups that caused me to make an approximation that are not present in the code that's on GitHub. So not only is it practical, but it better serves conservative slow trading needs where higher moments conflict with low risk tolerance. And I should add, it's better for illiquid securities because you can't afford to do fast trading. I think probably the most fundamental difference is that it brings options from an isolated continuous arbitrage model into a more realistic single period portfolio optimization framework. So you're free to go ahead and try it with using real option prices and see if you would buy them or not. Don't forget taxes. Okay, thanks again for coming. I'm going to see if I can get out of this and turn it back. I think I will turn it back to Shri.
Well, Jared, actually, you can just keep the host because in case you want to go back to any slides to answer any questions, so you can remain the host.
Okay, I'm not really sure how I get out of the view that I'm in.
Yeah, so now you ended the, so you just need to click on the.
I'm looking at something more familiar here.
But we can see you. We can see you in a smaller window.
All right. You know, when I go to real cooperative meetings, there's usually some good questions, and I feel really bad that I'm not getting any questions. Although I can rationalize it, you might be just stunned. Is that it? No. I read a paper once that the papers that get most referenced and have the biggest impact, and 90% of their content is stuff you already know and 10% is novel. And I screwed up, that I reversed the ratios. Okay.
Jared, I have a question on your longer horizon. This is Blake here. Those longer horizon stuff, you still had these moments mattering a lot at longer
They matter
horizon.
more and more.
More and more. And just my gut intuition was always that, at least, I mean, you said something that sort of also went against my intuition on that, is because returns generally get closer and closer to normality as you go to longer and longer horizons. That doesn't seem to matter to you, I guess.
I would phrase it as they get closer and closer to log normality, not normality.
Yeah. Right.
And that changes the skew in a positive direction, which would sort of make it more palatable. On the other hand, on the other hand, it increases the variance, and the fourth moment is the variance squared. And that really overcomes, until you get to quite long periods, like 5 years, you're going to get a lot of very negative effects from longer periods. So if we're talking about going from monthly to annual, let's say, you're going to see the need to take into account higher moments.
Mm-hmm. Okay.
Jared?
Yes.
This is Rudy Yaksik. I'm not that familiar with Rubinstein utility framework, but question is the implicit assumption that investors assign the same value to both positive and negative values of skewness, kurtosis, et cetera? In other words, there's downside.
No, the assumption is that the investor, whether they know it or not, can identify a level below which they will not go on purpose. And the difference between their current wealth and that level is defined as surplus. And the assumption is that you try to grow that surplus as fast as you can in terms of expected rate of growth. So it's growth optimal and surplus. And that's the only assumption other than what's necessary to support what's called a generalized central limit theorem, which means that the log returns, when you add a bunch of them together for different periods, become more and more normal. So in terms of what you're saying about direction, I don't know exactly how to map into that, but I know there's no assumption in a straightforward way like that.
Okay, the question was motivated by something called prospect theory, which you may be familiar with.
Yes, this will explain a good deal of prospect theory, because it says that in a person's mind, they have some level of loss that they would be extremely averse to. In this case, it says infinitely averse to. That's the way the log works as you get toward the left. So it's pretty consistent with prospect theory.
That's a point you might want to mention. Perhaps in
Okay,
your summary. Okay, thank you.
well, thanks again. I think that would do it for me. I'm going to stop the share, and as soon as I figure out how to do it, I'm going to turn control over to someone who knows how to work this.
You're doing a good job.
So I guess it's time to again socialize, get a beer and hang out. I got my kombucha with heavenly hops, if that counts as beer.
Well, I'll ask a question for the group. You know, as great as all this is and fundamental analysis and everything else, does it still matter if the Fed is just going to spend like $5 trillion and if stocks kind of can't go down, and a rising tide rises all ships?
You don't really believe stocks can't go down, do you?
No, I don't. Obviously they can, but I mean, I was reading an article where they compared real estate in China to stocks in the US, where they just like can't go down, and it just like won't be allowed.
Remember Argentina?
I'm aware of it. Anything specific about Argentina?
Argentina, the whole market disappeared. It was a while back.
Yep. I don't know, I've just been surprised at the extent of the intervention and markets as they've been. And I know that this isn't really, a group that tries to do what I'll call like market, commentary in a very kind of short time frame. But
So in my view, what you're doing is attempting to add alpha to the return matrix. So you're saying, oh, I think that the returns will be better than we saw in that past sample, or some other distribution change. I think that the skewness will not be as negative if people panic. And you're probably right. It's probably less than it could have been. I'm not making any assumptions there.
I don't know. I just thought that'd be a good kind of question to kind of throw to the group.
I had a question about Robinhood. Any formal research or anybody doing any work with respect to the Robinhood effect?
I'll just say that I read in the Wall Street Journal, obviously not doing research. I read in the Wall Street Journal that if they have like buys and sells, they can just settle in-house, they will, but then they sell their overflow to hedge funds that then front run it. And that's how you get what would be an otherwise small number of orders having an outsized impact. No idea if that's true.
We're very curious to see some real hardcore research on it.
Okay, I'm going to leave. The only thing I have to say is if anyone wants to try the Python code and they have questions, get in touch with me. I'd be happy to help.
Quick question, Jared, is obviously this feeds into the platform you're building, right?
Well, yes, it's kind of basic. To get to a platform that people can really use, the next step is to put in some kind of standard modifications of the return matrix, like shrinkage or even Michaud's work, or even a Bayesian prediction model. So this gives you the algorithm for the optimization, but it doesn't replace the person who is trying to add a better prediction.
Cool. So it's 7:50. Do we want to, I mean, we can continue it late, or? Hugh, any thoughts, any final announcements?
I don't have any. I just want to thank Jared for an excellent talk.
Thank you.